The world's greatest wealth transfer in history is here. According to the revered billionaire Ray Dalio, the stage is set for the world's greatest wealth transfer, an unprecedented event in human history. Join us as we unravel the intricacies of this monumental wealth transfer happening, impacting fortunes across the globe. Ray Dalio is no ordinary investor. He founded Bridgewater Associates back in 1975, and today it's the world's largest hedge fund. With Bridgewater's success, Ray's net worth soared to over $19 billion, making him the most respected macroeconomic investor globally. It's this respect that turned a simple LinkedIn post about the wealth transfer by Ray Dalio into a viral sensation covered by all major news outlets. But what exactly is this wealth transfer Ray Dalio is talking about in this LinkedIn post? Well, it's about trillions of dollars shifting hands in recent years, moving from governments and central banks to everyday citizens. This shift is benefiting average people during challenging economic times. Wealth has moved from the public sector, government and central banks, to the private sector, households and businesses. The impact? Households and businesses are in good financial shape with solid incomes, substantial net wealth, and low unemployment. This cushions them against the Federal Reserve's tightening of monetary policy. However, this shift comes at a cost to the government's financial health, a problem we all must face. Now, let's dig deeper into how this situation unfolded. Ray Dalio points out that in 2020 and 2021, the U.S. government had massive budget deficits. This simply means that the government was spending way more money than it was earning. When the government spends more than it earns, it typically plugs the hole and makes up for it by going into debt. This is usually done by the central bank, which prints money and buys government bonds. And yes, that's exactly what happened in these 2 years. The Federal Reserve, which is like the central bank in the U.S., increased its holdings of government bonds from 18% to 35% of the country's economic output, known as GDP. Now, a lot of this money that the government spent ended up in the hands of individuals and businesses. You might remember the economic stimulus checks that many people received. They played a big role in this. If we take a look at the personal savings rate in the U.S., we see a significant increase during that time of economic stimulus. People were saving more of their money. But then came 2022, and things changed. Inflation, which is when prices go up, was high, and unemployment, the number of people without jobs, was low. So the decision was made to step away from the cozy financial policies that had been in place. One key change was interest rates. Ray Dalio notes that the real bond rates, which is like the interest you earn on government bonds, went from being negative, meaning people were paying the government to hold their money, to a more normal positive level. This rise in interest rates led to a drop in the value of existing government bonds. This matters because many individuals and institutions, including banks, hold these bonds. When their value decreases, it means these holders incur losses, at least on paper. This situation triggered a regional banking crisis, as many banks were exposed to this interest rate risk. The Federal Reserve, another major holder of these bonds, also felt the impact as interest rates increased, making its balance sheet appear less favorable. Why is this a big deal? Well, the government is feeling the pain too, as it grapples with a substantial budget deficit. With much higher interest rates, the government will face significantly increased interest expenses on the debt it takes on in the coming years. In simple terms, borrowing money becomes more expensive, leading to higher interest payments.
I would say one wants to invest in countries that have good finances, good income statement, balance sheet, earning more than they spend, and have good, because they can withstand disruptions better.
As interest expenses consume more of the government's income, they face three options: finding additional revenue down the road, reducing spending, or raising taxes. Unwilling to pursue these, the government accumulates more debt, inching closer to a dangerous debt spiral. Ray Dalio subtly warns against deferring these issues indefinitely, as there's a limit to such postponement. Looking ahead, Dalio predicts that if government debt supply surpasses demand significantly, it could trigger slow growth and high inflation, a puzzle known as stagflation.
I think the inflation will come down a bit, but it's going to be very high, and money's going to get a lot tighter. So you're going to have a stagflation.
The concerning aspect emerges when considering a long-term perspective. Dalio firmly believes that central governments will consistently run large deficits, spending more than they earn. These deficits are likely to grow faster as the cost of servicing the debt, particularly interest payments, rise, setting the stage for a self-reinforcing debt spiral. This self-reinforcing debt spiral poses a grave threat to the economy, a concern that Ray Dalio strongly advocates addressing with proactive strategies to prevent its occurrence. So, what can be done to avoid a debt spiral, the dangerous situation Ray Dalio has been warning us about? It's not an easy fix, but it's essential to understand the steps that can be taken to prevent it. The first and most obvious step is for the United States to address its budget deficit. In simple terms, the government needs to stop spending more money than it earns. Once the deficit is stabilized, the next step is to work on reducing the country's overall debt. But here's the challenge. Taking these steps can be painful and unpopular in the world of politics. It often means cutting government spending or raising taxes, which isn't the best way to win votes. However, with enough determination, a country's financial situation can be turned around. Ray Dalio discusses this in his YouTube video titled, "How the Economic Machine Works." He describes a rare but possible economic scenario called a beautiful deleveraging. Dalio explains that deleveraging, which is the process of reducing debt, can either be ugly or beautiful. In a beautiful deleveraging, the first step is to cut spending. This means individuals, businesses, and even the government tighten their belts and spend less to pay down their debt. This is called austerity, and unfortunately, it can be painful. It might lead to job cuts and higher unemployment. While cutting spending is crucial to avoid a debt spiral, it can also mean lower incomes and more unemployment for people. The next step is reducing debts. Many borrowers find it tough to repay their loans. When this happens, it can create problems for banks, so debt restructuring becomes essential. This means lenders agree to get back less money, or extend the repayment time, or accept lower interest rates. It's a way to reduce debt, and lenders often prefer this over getting nothing back. However, there's a catch. As debts decrease, incomes and asset values might decrease faster, making the debt burden worse. It's like trying to solve one problem, but creating another. All these steps affect the central government. Lower incomes and higher unemployment means less tax money coming in. But at the same time, the government needs to spend more to support those who are out of work. So governments often create stimulus plans to boost the economy, which leads to budget deficits, spending more than they earn. Now for the third part of a beautiful deleveraging, we talk about redistribution of wealth. It's not about taking money from the government and handing it to people directly. Instead, it involves taxing wealthier individuals and corporations to help the government balance its budget. This is important because wealth is often concentrated in a small group of people. The fourth and final step is printing money. Unlike the earlier steps, this one is inflationary and stimulates the economy. The central bank can create new money out of thin air and use it to buy financial assets and government bonds, but it can't buy goods and services. The central government, on the other hand, can buy goods and services but can't print money, so they have to work together. The central bank lends money to the government, allowing it to run a deficit and increase spending. This puts more money in people's hands and helps reduce the overall debt. However, it's a risky strategy. Balancing deflationary steps, like cutting spending and reducing debt, with inflationary ones, like printing money, is crucial to maintaining stability. In the United States, we've seen a lot of money printing, which has eased things in the short term, but it has also led to high inflation. To avoid a debt spiral, the U.S. now needs to cut spending and raise taxes to address its worsening deficit. Ray Dalio is concerned about whether the U.S. can take these steps, or if it will keep printing money, delaying the problem, and potentially falling into a debt spiral. If you're interested in learning more about the U.S. economy, click the video on screen now, where we take a deeper dive into the U.S. economy and why the U.S. economy is collapsing.